Okay, so in this video, I'm going to talk briefly about due diligence. What is it? When is it? And what's all involved in that? All right, this when I'm talking about due diligence, I'm talking about when you're the one who's actively running the property. So if you're looking at this as a passive investment, then that's what your operators would be doing. So due diligence comes into play once the property is under contract. And under contract means someone has made an offer, the seller has accepted the offer. Now, it doesn't usually go that quickly. There's usually lots of negotiations back and forth, but ultimately, once a final agreement has been made, now you're under contract, it's considered executed, and there's always some period of time. It's usually between 15 and 30 days, depending on the size of the property, sometimes even as much as 45 days, but let's just say it's 15 to 35 days. And it's this period of time where the operators of the property can get in there and figure out what about the property is real? What about the property was projections from the seller that are not actually accurate? So that's the whole process of doing due diligence. Because sometimes when a seller is selling a property, they're like, oh yeah, here's all the opportunities that you could do. And well, why didn't you do it? Right. So you really need to vet out, or the operator really needs to vet out, what is the truth of this property? Because that is going to impact the financial projections that are made in order to tell the passive investors, these are the returns that we're expecting based on our business plan. So there's two kinds of due diligence. There's physical due diligence and there's financial due diligence. And we always start by doing financial due diligence because physical due diligence has a cost associated with it. When you get into apartments, it's a fairly high cost associated with having inspections done, especially the larger and larger you get into, or the larger the properties. So a financial due diligence is when the operator's looking at any and everything that would impact the revenues or the expenses of the property. So it's common that you would be looking at every single lease, because when the seller's selling the property, they'll usually give a rent roll. And a rent roll is a list of here's all the units, here's all the tenants, here's what they're paying for rent, here's their security deposit, etc. So they could have put that together on an Excel spreadsheet. Like, how do you know? So due diligence, it's almost like if you think, like, I used to be an auditor. That was my background. I used to audit businesses. And when it comes to real estate, it's almost like you're auditing the real estate, you're auditing the financials. So right now, what I'm auditing is the revenue. Well, how do I make sure that the revenue that the seller's showing is real, is accurate? One of the main things that we do is we do a lease review. So we literally get a copy of every single solitary lease and we match it up to the rent roll to make sure they should match exactly. The name should be the same, the move-in date, the end of lease date, the monthly rent amount, the security deposit, all of it should match exactly. Sometimes it does, and sometimes it doesn't. So it's up to the operator to review each lease and any adjustment that needs to be made to the rent roll. Like, okay, well, they said it's $1,000 a month, but according to the lease, it's only $900 a month. And so maybe it was a clerical error, or maybe the seller's trying to pull one over on them. Like, who knows? We don't make any assumptions. We just want to find out what's real. So the operator would then go and create their own spreadsheet and say, okay, based on all of my lease reviews, this is the actual revenue of the property. And when it comes to the rent, all right? So that's part of financial due diligence. Another thing that we do with financial due diligence is we look at the last 12 months. Well, we actually look for the last 2 years of financials, but we look on a month-by-month basis. That is called a T12, a trailing 12. And so what we're looking at is every month, what are the different expenses? So we're seeing, property taxes, insurance, maintenance, property management, marketing, all of the different expenses that you would expect to see. And we want to see them month by month or month by month, because we want to see, is there anything that doesn't make sense? For example, let's say we're buying a property in Ohio and it's July and August and we're seeing snow removal and there's numbers there. Well, that doesn't make any sense, because in July and August, why would there be snow removal in Ohio? The same is true if we're looking in December, January, February, and snow removal has a $0 line item. That doesn't make sense either, because it's Ohio, it snows, there should be some kind of snow removal expense in those months. So that's the type of thing that the operators are doing during due diligence, is they're literally looking line item by line item by line item, month by month, and making sure that it makes sense. That's one step. The other step is for people who own property, when they sell it to the next buyer, some of the expenses are not the same. So if you think about like property taxes, that's a number that can change. And that is wholly dependent on where the property is located, how often they reassess taxes. Like how do they create the property tax bill? Like, what is it based on? So that's part of the operator's job during due diligence, is to not just look at what are the current property taxes. It's almost like the current property taxes are somewhat irrelevant. It's to get in there and audit and dig through and talk to the assessor's office and figure out what are the property taxes going to be for us when we close. And then those are the numbers that we're including in our financial projections. So even from day one, it might be the same amount that the seller's currently paying, because it doesn't usually go up overnight. But putting that in, but also putting in what is the amount going to be and when is it going to change to that. So that's the type of financial due diligence. Another one that's really common to change is insurance. So if the seller bought the property for $1 million, 10 years ago, and you're buying it now for $2.5 million or $3 million, your insurance is likely going to be different than their insurance. So you're not relying on their numbers in your financial projections. You are going and getting your own insurance quotes and using those numbers in the financial projections. I say you, I mean the operators of the deal. But those are all the financial due diligence. Financial due diligence takes time. It takes a very keen eye, massive attention to detail, but there's no cost associated with it. Physical due diligence. So you always want to knock out the financial due diligence, because frankly, if you start looking at all those things and you realize this deal does not make sense, they are totally overstating the revenue, or they're understated expenses, or wow, the property taxes are going to go up so much that it makes the numbers not work, then you don't want to go pay thousands and thousands of dollars for an inspection if you know the deal cannot work based on the current financial due diligence. All right. So when you're talking to operators and they are doing financial due diligence first, they haven't done the inspection yet. That's why. And that's, we literally have been teaching this to all of the people we've taught real estate to, like, don't pay for the inspection until you're done with the financial due diligence and the deal still works. Right. The physical due diligence looks like a couple of things, depending on what the project is going to be. If you're literally just buying something that you're taking over, then the physical due diligence is primarily going to be a building inspection. The thing is, you always want to make sure that the operating team had the inspectors or somebody go to every single unit and put eyes on it and assess. Because the last thing you want to do is buy a property and find out, well, they looked at 5 out of 20 units, and the other 15 units that nobody saw are a total disaster. Like that, your financial projections they're not going to work then. So that's a really important piece, is to make sure that there's been eyes on every single unit. But the building inspector is also looking at things like the structure, if there's a basement, the major mechanicals, the roof, like any big items that could severely impact the financial performance of the deal. Other types of physical due diligence, if the opportunity in the building is to increase the net operating income by raising rents because you've renovated units. Because if you think about it, if there's a tenant and they're looking at this unit and they're looking at this unit, and this unit is like got granite countertops and like it's just all the current everything, it looks so nice, that's going to be more valuable to them than a unit that is just got, it's still fine, there's nothing wrong with it, but it's not been updated, right? So one of the opportunities oftentimes is to go into a building, and if it hasn't already been renovated, is to renovate the units if there's enough of a difference between what they're currently getting. Let's say the standard units are $1,000, but you can get $1,250 a month for a renovated unit. You got to go through all the financials and crunch the numbers on that. But that usually is one where you're going to want to renovate, because that extra $250 a month, first of all, it turns into a lot more cash flow over the course of the year, right? That's going to be, let's say 250 times 12 is an extra $3,000 a year per unit. Plus, like I showed you in the last video, every time you increase the revenue, you increase the value of the property. So anyway, if you're doing rehab, then the other part of your physical due diligence is going to be getting a contractor in there, or whoever is going to be doing the work. So sometimes when you get into larger and larger properties, the property management company has a rehab arm, or they have contractors that they work with. So whoever it is, you want to get them in to make sure that you have quotes, because that's going to help you determine how much capital you need to raise, how much capital the operators need to raise, or like what is the actual return, cash on cash return going to be based on how much capital is raised, and how much of an opportunity is there to raise rent, and how often are you going to raise rents, or how often are you going to renovate units? What if there's already tenants in there? You don't really want to kick tenants out and have no revenue. So like, what does that look like as far as the business plan? So the other physical due diligence is literally getting someone in there who can tell you, here's the condition of the unit. Here's what it's going to cost to get it to this next level of condition. So those are the general things. There's more to it. Obviously, with financial and physical due diligence, there's going to be, there's a lot of little nuances, but those are kind of the main things so that you understand like what is being done on the other end, or if you're going to do it actively, what needs to be done on your end. Most importantly, if you're going to be investing in a deal that you weren't involved in doing all the due diligence on, is you want to make sure you're asking a lot of questions so that you can feel comfortable and confident that the operating team did a thorough due diligence. Like, don't ever be afraid to ask questions, even the hard questions. And frankly, if the kind of response you're getting is annoyance, if someone's annoyed that you're asking questions, that should be a red flag right there, right? Because you should be able to ask any questions. It's your money that you're putting into a deal and you want to feel good about it. You want to feel secure about it. The more questions you ask, the better you're going to get at evaluating properties and the more knowledgeable you're going to feel and the more confident you're going to feel. So ask lots and lots and lots of questions. It's going to help you. And frankly, if you're on a live webinar and you're asking questions, there's probably all sorts of other people that are benefiting from your questions as well. So don't be shy about that. Ask your questions and make sure that you're confident. So when you make your decision, you've made it from a place of, okay, I feel like I have as much information as I can have to make an informed decision about the risks and rewards. All right. I hope that helps.